So children, today we are going to study about central bank. First, let's understand the meaning of the central bank. What is central bank? Central bank is the supreme monetary institution at the apex of the monetary and banking structure of a country. That means apex means topmost. Fine. Why we call it a topmost? Because all policies regarding bank rates, all credit policies, or whatever is being decided in the country, whatever rules are being followed by commercial bank or financial institution, all the decisions are being taken by central bank. So that is why it is called a supreme monetary institution, or you can say a apex of the monetary and banking structure of a country. Okay, it is the leader of money market and as such control, regulate and supervises the activity of commercial bank. It is the central monetary authority which manages the currency and credit policy of the country and functions as a banker to the government as well as to the commercial bank. So it acts as what? Bankers to the government. Okay, and even it helps as a what we say backup. Backup means what? Means whenever government or commercial bank needs any financial help or any need, so central bank comes forward for that. Children, let's understand the difference between central bank and commercial bank. Do remember nowadays both are very specific in giving questions, so they can ask you differentiation on grounds of meaning and object, or meaning and ownership, or meaning and note issues, or object and note issues. It can be any. So what I mean to say that learn each and every point perfectly. Fine. Now what is the meaning? Central bank is an apex institution of the monetary and banking structure of the country. It regulates the entire banking system of the country. I have already explained you it is the apex institution. Fine. Now commercial bank I have already explained in my last video. Commercial bank is a bank which deals in money and credit for purpose of earning profit. It just operates under the guideline of the central bank. Okay. Then what is the object? Its main object is to promote social welfare. They are not profit motive. Whereas commercial bank, they are there to earn profit. So its main object is to earn profit. Ownership. Central bank is generally a government owned institution. Now commercial bank can be both private owned or government owned institution. Now in case of note issues, we know very well that central bank has the monopoly. They have the only rights to issue the notes, whereas commercial banks, they do not have such rights. Now banker, it is a banker of the government. It is also the banker of the commercial bank, and it has no direct contact with public dealing. Fine. Whereas commercial bank is a banker of the general public only. It has a direct public dealing. Fine. Now numbers, there can be only one central bank in the country. Beta, do remember they may have branches, but then bank will be only one. Whereas commercial bank, they can have there can be a number of commercial banks in every country. Fine. And they can have n number of branches all over the country also, and even abroad. Next topic is functions of central bank. Now first is bank of note issue. We know very well central bank has the sole monopoly to issue currency notes. Okay, so that is why it is called what? Bank of issue. Now you can get it as a question, which bank is called as a bank of issue? So do remember that is central bank. Fine. Commercial bank cannot issue currency notes. We know that. That is what we have studied just now. The currency so created is called high powered money. Do remember what is called high powered money? The currency which is being created by central bank, that is high powered money. Okay. Now currency notes and coins issued by the central bank are the legal tender money. We have studied this point in money. Got it? So this is what? Legal tender money. Why we call it as a legal tender? You know very well on currencies there is a signature. Whenever there is a signature, it is a legal tender. Got it? So I hope it is clear. Now we have to understand why such rights are being given to only one bank, that is central bank. So following are the main reasons why this monopoly is being given to central bank. First is to bring about uniformity in note circulation. You know very well, we have only one kind of note. If it is 100 rupees, it will be similar of its kind. So what we can do, we can recognize it. Why? Because it is uniform all around the country. Okay. It is easier to control money supply when there is a single agency of note issue. So if one person is doing it, is easy to control. We know what will be the system, what is the print, what will be the lookout. Okay, everything is clear. It keeps the public faith in the paper currency. No doubt, when you know everything is been organized and properly controlled and is been coming through one end, so what you have, you trust that. Fine. So what is there? Faith is there. It helps in the stabilization of internal and external value of the money. Now, when we have a faith, no doubt internal means within the domestic territory and even abroad, there may be some stabilization. Okay. Others will demand. Some stabilization means what? There will be a demand for it. Okay. So this is, it means what is the reason behind giving this kind of monopoly? That means a single central bank for note issue. This kind of power has been given to them because of following reasons. Now next is banker, agent and advisor to the government. Whenever you are answering this point, you have to understand that you have to separately explain each and every point. Okay, don't mix it up. Like first is banker. So as a banker, what they do? As a banker to the government, it has to perform following functions, which are the first, it manages the banking account of the government department. So whatever you see, whatever financial issues are being given by the government, everything that is being controlled, or you can say come through central bank only. Second is, it performs the same banking function to the government as commercial bank performs for its customer. It accepts deposits and make payments for the government. So what commercial bank do? Whatever functions we have studied about commercial bank, same function is being followed by RBI, but they do it only for government, not for common public. Okay. Now it also gives short period loan to the government. Likewise, the commercial bank gives to common public, same way central bank gives to government. Okay. Next is as physical agent. That is agent. Now as a physical agent, it has to perform following functions. It manages the public borrowing. It collects taxes and other payments on behalf of the government. Now what is public borrowing? To understand, that is again the part of government. It is not of commercial bank type. Okay, common public they don't deal with. They are dealing with what? Government. So whatever public borrowing is being taken by the government, that they checks out. Now public borrowing you will understand more in our next topic, that is we have finance and budget revenue. So we will understand in that. Okay. Now it represents the government in the international financial institution. International means IMF, World Bank. So what they do, they represent the country over there. Moreover, one more point, that is they collect taxes and other payments on behalf of the government, which I already told you. So what they do, they collect all the taxes, whatever is been taxes which is been collected in the country. So that is all been taken by whom? Central bank. Fine. Now as advisors, the central bank also acts as the financial advisor to the government. It gives advices to the government on all financial and economic matters such as deficit financing, devaluation of currency, trade policy, foreign exchange policy. Now these are the topics which you are going to deal in your further chapters, and moreover these are the topics which you will come through in your 12th standard. Okay, so they advises the government on all these cases. Next is banker to the bank. We know they are banker to the bank. That means they control the banker regulation. Which bank? Commercial bank. Fine. So that is what we are going to study ahead. Now what will be included in banker to the bank? First is as a custodian of the cash reserve of the commercial bank. Now what do you mean by custodian of the cash reserve? Means whatever cash reserves commercial bank have. Okay, they keep it where? They keep it with RBI. The way common public keep it with commercial banks keep their reserves with RBI. Fine. So the central bank maintains the cash reserve of the commercial banks. Every commercial bank has to keep a certain percentage of his cash reserve with the central bank by law. Now it is mandatory for them to keep cash reserve. Okay, you must have heard CRR, cash reserve ratio, right? Now what is cash reserve ratio? Cash reserve ratio means that ratio which commercial bank keeps mandatorily means compulsorily with central bank. Okay, so that is cash reserve ratio. Fine. Now as a lender of the last resort, now what do you mean by as a lender of a last resort? As a banker to the bank, the central bank acts as the lender of the last resort. In other words, in case the commercial bank fails to meet their financial requirement from other sources. Okay, so what happened? Commercial bank will approach whom? Central bank for loans. Fine, and they have to give. So that is lender of last resort. You can say last hope for the commercial bank. In case if at all they are not getting any financial assistance from anywhere, so they will definitely get it from central bank. Okay, as clearing agent. Now, as the custodian of cash reserve of the commercial bank, the central bank acts as the clearing house of these banks. Since all banks have their accounts with the central bank can easily settle the claim of various banks against each other simply by booking entries of transfer from and to their account. This method of settling account is called clearinghouse function of the central bank. Now those who know some of the accounts, they must be knowing what is as clearing agent. That means what they do, they just transfer the entry. Fine, cancellation entry you can say, that once they have given, then they just cancel it in their name. You will not understand this much because this is a part of accounts. Unless and until you are clear with your journal entries and all, you will not be very clear with this part. But to understand for now and then, that they just transfer the entry once in plus then in minus. Okay, this is what right now you have to understand, so that the things can be settled down. Fine. Next is as supervisor. The central bank supervises, regulates and controls the commercial bank. This function is done by using its vested power relating to licensing, branch expansion, liquidity of assets, amalgamation, liquidation. Okay, now what do you mean by branch expansion? That means more branches to be opened up. Liquidity of assets, that means settling down, selling of assets. Amalgamation, that means merging of two banks. Liquidation, that means winding up of the bank. In case if at all any such cases arises, central bank will be there to supervise, to check out everything. Next is custodian of foreign exchange reserve. What do you mean by custodian? Again, custodian means taking into custody, keeping with them. Central bank keep all foreign exchange reserves. That means currencies of different countries which comes to the India, which is coming to India. Okay, so whatever US dollars, British pounds, or whatever currencies or gold stock, you can say, everything, who keep all these reserves? Central bank keep all these reserves. Okay, the central bank also functions as a custodian of all foreign exchange reserve. Key currencies such as US dollars, British pounds and other prominent currencies, gold stock and gold bullions and other such reserves in its custody. This right of commercial banks helps it to overcome the balance of payment difficulties to maintain stability in the exchange rate. Now, balance of payment means when we go work out internationally. Okay, so export and import carries out. So, balancing between them, that means making payment for imports and taking the receipts. Fine, these all are being maintained through this custodian function of foreign exchange reserve. Okay, next is controller of credit. Now controller of credit means, that means whatever credit system goes on in the country, that has been all the rules and regulations are being directed from central bank. Now, controlling credit has become the most important function of the central bank in the modern times. Uncontrolled credit causes economic fluctuation in the economy. By controlling the credit effectively, the central bank established stability not only in the internal price level but also in the foreign exchange rates. So you must have seen that India's currency value sometime going up and then sometime going down. So this is what, this is again somehow being maintained and managed by central bank. Now this system, all everything you will understand in your 12th standard. Okay, right now for now you understand whatever is being credit system which goes on in the country. To stabilize that, RBI directs all the rules and regulations. Okay, and because of this the economy growth is there and smooth functioning of economy is being carried out. Okay, in short, let's understand the functions of central bank quickly at the end of the day. First is bank of note issue, then banker to the government, then banker to the bank, then custodian of foreign exchange reserve, controller of credit, promoter of economic development. So these are the different functions which are being performed by central bank. Now next we are going to study about monetary policies of the central bank. We have all studied that they control credit, they do this, they do that. Now how they do that? What are the methods? So this method is being through monetary policy. Fine. Now monetary policy refers to the measures. Mark these points better. These are the meaning. Okay, so you have to understand these meaning. What is monetary policy? Monetary policy refers to the measures adopted by the central bank to regulate the supply of money and credit in the economy. Fine. So this is the meaning of monetary policy. Instruments of monetary policy, if at all we will check out, it will be divided in two categories. First is quantitative method, second is qualitative method. Now you can be asked what are the instruments of monetary policy. Don't get confused. Two instruments are there. One is qualitative, another is quantitative method. Now what do you mean by quantitative method? The method issued by the central bank to influence the total volume of credit in the banking system are called quantitative method of credit control. These methods regulate the lending ability of the financial sector of the whole economy. These methods include bank rate, open market, operations, legal reserve requirement. Now do remember quantitative name itself you will come to know. Quantitative means that one which is touching the large core of the country. Now large core, that is quantitative. Okay, so what is quantitative? It is the method which is being used by the central bank to influence the total volume of credit in the banking system. Total means all together. Fine. So understand the meaning. Now which are the things which is being included in this? That is bank rate, open market operations and legal reserve requirement. Now let's study each and every point one by one in short. Now let's understand about bank rate. The bank rate policy is the traditional method of credit control used by a central bank. The bank rate is the rate at which a central bank lends money to member commercial bank against approved security or eligible bills of exchange. Fine. So do remember what is bank rate. Bank rate means that rate on which RBI lends. RBI, that is central bank. You know RBI is the Central Bank of India. So they lend money to commercial bank. Okay, on any approved security. Approved security means any legal document. Fine. Now what happens if there is an increase in bank rate during inflation to control the volume of credit? Inflation means what? Inflation means, to remember, it is a state in which the cost of the general price level goes on increasing continuously. That is inflation. Okay, so to control that, what RBI do? they used to increase the bank rate. Now what will happen if they will increase the bank rate? If they will increase the bank rate, no doubt when commercial bank will get high rate loan, they will give loan at high rate only. I hope it is clear. What do you mean? What I mean to say, see, when they are taking money from RBI, central bank, they used to take that money and give it to common public. When they themselves are getting loan at a high rate, what they will do, even they will charge high rate to the public. Now what public will be? Public will not be much interested in the money. Why? Because rates are very high, bank rates are very high, interest rates. Fine. So that is the case in case of increase in bank rate. Now decrease in bank rate, I hope you know very well. That is a case of deflation. Deflation means now what is the situation? The cost of the product is low. Okay, now people are not much interested in purchasing, or you can say they are not, there is no demand in the country. Okay, money supply is less. Now what bank has to do? RBI has to see that the circulation of money should increase. Now how circulation will increase? When they will charge less rate of interest. Okay, so what happened in that case? They decrease their bank rate. Next is open market operations. Now what do you mean by open market operations? This refers to buying and selling of government securities. You know very well, national saving certificates and all. Okay, by the central bank from, or you can say to the public and bank. Okay, now OMO means open market operations are used to influence money supply in the country. It does not matter where the securities are bought and sold to the public or banks. Money ultimately is deposited in or transferred from the bank. Fine. Now what happened? It can be from a common public or anything, but then whomsoever is performing the function, ultimately the money will go to bank. So that is what open market operations. That means they are going through with the common public, but through commercial banks. Or you must have seen that post office used to issue all these securities and all. Fine. So that is open market operations. Next is legal reserve requirement. Now in legal reserve requirement, we have many in that, under that. First is cash reserve ratio. Now I have already explained you cash reserve ratio a bit. Cash reserve ratio means CRR. It refers to the minimum percentage of total demand and time deposit to be kept by commercial bank with the central bank. Okay. Now, a change in CRR affects the power of commercial bank to create credit. How? What do you mean by CRR? CRR means minimum amount which commercial bank has to keep with central bank. Okay. Now, if at all CRR is increased, that means if the cash reserve which commercial bank has to keep with central bank is more, what will happen? They will be left out with less money. If they will be left out with less money, what they will do? They will be able to give loan less to common public, right? Now vice versa, if at all CRR is decreased, that means cash reserve which will be kept by commercial bank in central bank is decreased, less. So what will be the result? Commercial bank will be left out with more money. Now more, they can lend more loans. Fine. So that is the effect of CRR. Now SLR. SLR is what? Statutory liquidity ratio. SLR is another component of legal reserve requirement. It refers to the minimum percentage of net demand and time deposits with which commercial banks are required to maintain with themselves. Okay, now they are keeping money with themselves. Fine. So that is what? That is SLR. SLR is maintained in the form of cash or other liquid assets. Other liquid assets means any asset which can be immediately converted into cash. Okay, you can say for example gold. Change in SLR affects the availability of credit. Now if at all central bank increases SLR during the period of inflation, an increase in SLR reduces the amount of excess reserve of the bank. SLR, that is minimum amount which they have to keep with them. Okay, that means commercial bank mandatorily will keep that, compulsorily will keep that much amount minimum with them by law. Okay, if at all it is more, no doubt the money which will be left out for giving loan will be less, and vice versa. This was all about quantitative method. Now let's understand qualitative method. Qualitative, you can say selective. Okay, qualitative method refers to those instruments of monetary policy of the central bank which direct or restrict the flow of credit to specific area or sectors. Okay, so that is who should get more credit or who should get less credit. This has been decided where? In qualitative method. Fine. Now this method is also called as what? Selective method. Now what are being included in selective method, or you can say qualitative method? First is regulation of customers' credit. Now what does that means? You may have seen that people used to take motor car, house, computers on EMI. EMI, that is hire purchase system. Okay, so that is what? That is consumers' credit. Now under this method, the credit given to durable consumer goods is controlled. Durable consumer goods which is being purchased under hire purchase system, and payment is made in installment. Okay, now in time of inflation, what happened? Consumers credit is reduced. In time of deflation, credit is expanded. That means the rate of interest is high in inflation. Why? Because now here it has been needed to control the supply of money, cut down, curb the supply of money. Fine. Whereas in case of deflation, what they need to expand the circulation of money. Okay, these are the situation you can be asked for. Like inflation, they need to expand, or they need to curb, or you can say curtail the supply of money. So in case of inflation, curbing or curtailing or cut down of supply of money is there, and vice versa. So do remember that. Okay, these are very small points, but then you have to understand. Then next is regulation of margin requirement. Now what is margin requirement? Whenever you are going for a loan by taking your security, suppose for example your security has a value of 1 lakh rupees. So when you go for a loan, no doubt bank will not give you complete 1 lakh. What they will do? They will keep some of the amount with them. That means they will cut down some of the amount. Suppose they give you 80,000. Fine. So that 20,000 which they keep with them is what? That is margin requirement. Now this regulation is being done by whom? By RBI, or you can say central bank, in qualitative method. Now this can be increased and this can be decreased. What do you mean by increase? Increase means maybe the margin requirement they can keep more. Fine. Like previously they were keeping with them only 20,000 and giving you 80,000 back. Now they are keeping with them 40,000 and giving you 60,000 back. So what is that? They have increased. Now here increase means what? Again they want to curb, or you can say curtail the supply of money. Same way, if at all they want to increase, what they will do? They will reduce the margin requirement. Fine. So margin requirement refers to the difference between the amount of loan granted and the value of securities offered for the loan. So this is what I have explained everything with example. I hope you got the things very clearly. Next is credit rationing. Now what do you mean by credit rationing? I hope you must have heard ration shops, right? Now what happened in ration shops? The things are being controlled and been guided. That means you go for a particular, suppose for example rice you will get at less rate for particular kind of people, right? Like the one who has a what we say yellow card, so who are being below poverty line. So this is what rationing. Now here also RBI do credit rationing. Now how they go for credit rationing? First and foremost, let's understand the meaning. Rationing of credit is another instrument of selective credit control. It aims at limiting the maximum, or you can say ceiling amount of bank loan and advances. Rationing of credit may take the following two forms, which are the central bank may fix the maximum amount of loans and advances which can be given by the commercial bank. Fine. The central bank may fix the maximum ratio of loans and advances of a commercial bank to its total deposits. So what they can do? They can guide commercial bank that you will provide loan at only till this extent. Okay, they can fix that amount. Or what they can do? They can fix maximum ratio of loan and advances. That means you will only give this much ratio to particular type of industry. So they can guide in that way. That is credit rationing. Now what is moral suasion? Because this is a very important point. Moral suasion basically many a time it comes for 2 marks, or you can say as a separate point. Now under this method, the central bank adopts the policy of persuasion and moral influence of the commercial bank in order to get them to fall in the line with its policy. The central bank frequently announces its policy and urges the commercial bank to adopt it. This is exercised through letters, discussion and directives to the banks. Now here what happened? They carry out a simple meeting, or you can say they direct the authorities of the bank through letters and all, that you have to go for this rule. They don't declare it publicly, but they give it to specific banks only. Fine. Now what they have to do, as it is been ordered by the head of the bank, that means apex body, they have to follow it strictly. Okay, so that is what? That is moral suasion. Moral suasion means directly giving them advices, but advices is not just an advice. Strictly they have to follow it. That is moral suasion. Now so far it's all clear, I hope. This is the difference between qualitative and quantitative methods. So I will just quickly read it out because I have already explained this point. First is nature. These methods influence the total volume of credit without differentiating between essential and non-essential uses of credit. These methods are mostly indirect and impersonal. Now this is what? Quantitative method. What is qualitative method? These methods are discriminatory in nature in the sense that they differentiate between essentials and non-essential uses of the credit. These methods are more direct. Second is effect. These methods affect the lenders. This is quantitative. Now what is qualitative? This method affects both lenders as well as borrowers. Now in quantitative, what are the methods which are being used? Bank rate, open market operations, cash reserve ratio, statutory liquidity ratio. Now in case of qualitative, which are the methods which are being used? Customers credit, margin requirement, rationing of credit, moral suasion. So these are the things which are being explained. This is all for central bank. I hope the topic is clear to you. Any difficulty you can definitely question and I will definitely reply that. All the best. We will proceed further in our next video.